Hello everyone. So today I want to talk about Unum Group, which I think is perhaps one of the most undervalued stocks on the market today. Ticker symbol UNM. Unum Group operates in the U.S. and abroad, in the United States, England, Poland, and other countries. It offers insurance, short-term disability, life insurance, accidental death, and other products, as well as vision, dental, accident, sickness, and critical illness products. It also offers various other insurance products. It's based in Chattanooga, Tennessee. Looking at the graph on Fast Graphs, we can see that Unum Group, the stock is trading at a really low level right now. Since the end of last year, it's dropped from around 30. It's kind of been cut in half. Now it's under $16 a share. It was already trading at low levels at the beginning of this year. Just at around under 6, at a ratio of 6 price per earnings ratio, and now it's down below 3. Really low level right now. It's majority owned by institutional investors, over 90%. But we can see the blue line represents the historical average price to earnings ratio, which is around 9.3 over the past 15 years. And we can see it kind of goes back and forth. Sometimes it's above and below, but it never seems to come close to the normal PE of 15. Now this company is growing. The dividend has been growing every year for the past I'd say at least 11 years, and it's had a dividend every year for the past 15 years, going from 30 cents per share till recently, 2019, it was over $1 a share of dividend. It looks to be extremely undervalued, and I made a spreadsheet. We can see that the shares outstanding here have gone from 300 million to 200 million in the past 15 years. So basically the company has rebought 1/3 of the shares outstanding, which is pretty good. And the income has also gone up from 500 million to over $1 billion this last year. Now it does pay a dividend. We can see the historical dividend growth rate from 2005 to 2019 is about 9% per year on average. Recently, it's been much higher than that. And the earnings per share has also, with the drop in the number of shares, has gone up from $1.6 per share to over $5 per share in the last 15 years. I'm not sure I really understand why the share price has dropped so much, but it seems to be some panic selling going on. And if we look back to the last financial crisis back in 2008, we can see here that the price did drop quite a bit. It went from 25 down to 10, but then fairly quickly rebounded back above 20 within a year. And so will we see a similar thing here in the present day, where it dropped from 30 down to 15? Regardless, taking a look to the future, I'm forecasting to 10 years from now, projecting to 2030. We can see the shares outstanding, like I said, went down from 300 to 200, 313 down to 210 million shares over the course of about 15 years. If we can project that to continue for the next 10 years, let's just assume the shares outstanding drop from 210 down to 160, we'll say, to keep it safe. Conservative estimates. Now, recently they did announce that they are stopping their share repurchase program for the time being, but it would seem like now would be a great chance for them to buy up shares really cheap. But regardless, the net income, if we forecast that, in 2005 the net income was around 500 million, and in 2019 it was over $1 billion, 1.1 billion. So let's just say conservatively, I mean, this may or may not happen, of course, but if income rises to 1.5 billion by 2030, and that would give us a PE ratio with the reduced number of shares and increased income. That would give us roughly, okay, well, assuming a PE ratio of 9, that would give us earnings per share of $9.40 and a share price of 84.4. Assuming it can get back to that PE of 9. Now, if we want to take a look at the future dividend growth, historically, it's gone up quite a bit in the last 15 years and averaging 9% per year growth rate. Now, if we just want to assume it's going to kind of level off and they're going to grow dividends at 2% per year, we'd be looking at a dividend of $1.36 in 2030. Let's say if it grows at 4% per year, we'd be looking at a dividend of $1.70, roughly $1.70 in 2030. Now, including the dividends and the compound annual growth rate calculation, if we assuming we reinvest all these future dividends and assuming the stock price kind of has a more smooth growth, which it won't, but just assuming it does, we get a compound annual growth rate of roughly 23% over the next 10 years, assuming a PE of 9. Now, if we want to take that up to assume like a PE of 12, which sometimes it has hit in the past, that would give us a, not including dividends, the compound annual growth rate would be around 22% per year for the next 10 years, and a share price of $113 roughly. So that's pretty amazing returns over the next 10 years. And if we want to kind of give them more benefit of the doubt and say they buy back more shares and the shares outstanding drop to 140, we can see that with a PE of 9, the compound annual growth rate hits 20% without dividends and almost goes up to 25%, including the dividends reinvested back into the stock. If we go up to a PE ratio of 12, assuming that the PE ratio comes back up to 12 by 2030, it's kind of the compound annual growth rate without dividends is roughly 23.5%. With dividends, it goes up to 28%. So once again, this stock appears to be pretty undervalued and seems to be one of the most undervalued value stocks there is. But given its growth rate, it seems to be a semi-growth stock given its current low level. Once again,